Hi, friends. Welcome back to The Skinny on Wall Street with Kristen and Jen. This is Kristen.
I'm Jen.
And this is our second weekly podcast episode where we give you the skinny on random stuff going on in the markets or anything else that happens to be on our mind. And so today we're going to get into a number of different topics. There was this whole T+1 settlement change that I personally don't know very much about that Jen's going to walk us through. That was just implemented yesterday. What was it? May 29th or something?
Tuesday. May 28th. Yep.
May 28th. The second thing we're going to get into is there was a news article that came out last week about I think it was a $79 million fine that Citi had to pay as a result of a fat finger trade. And the details are kind of shocking. And so we're going to get into basically why that happened, but also, use it as a way to talk about why attention to detail is just so important for anybody who is starting their careers right now or entering into an internship program. And then we also want to talk a little bit about what's going on in the fundraising space. So there was an article that came out on Bloomberg that was basically just walking through why fundraising for hedge funds is down so much. And basically it's the fault of private equity. So anyway, we have a number of
always
things.
Private equity's fault.
It's always private equity.
It's like blame Canada,
and actually,
blame private equity.
Exactly. Well, and actually along those lines, we wanted to touch a little bit on private credit because that's going to be the episode we have coming out this week. So we wanted to touch a little bit on just like what the heck is private credit anyway. And so let's begin with Jen.
Yeah, let's get into it because we got a lot to talk about.
We got a lot to talk about. So Jen, if you can start with the settlement T+1 change that is now.
Yeah, so I'm going to take us back in time to February of 2023. This is before the collapse of SVB. These are ancient times. The Wall Street Skinny hadn't yet aired its first episode. So last year, the SEC modified the settlement rules for a whole host of securities from what's called T+2 to T+1. And the day after Memorial Day this year, 2024, May 28th, the Tuesday after a 3-day holiday in America, because great timing, guys, that was the mandatory compliance date for the switch to actually take place. So we want to explain quickly what all this means and why it matters. So first of all, what is trade settlement? Okay, for most transactions that happen in the global securities market, when you do a trade, you either verbally say done or you click a button on an electronic interface. Okay, but think about it this way. When you buy a dress on Revolve or like you order a pair of shoes on Amazon, and you click confirm my purchase, the dress or the shoes, they don't just magically apparate in front of you, right? The order has to be processed. It has to go down to a warehouse. They have to start the shipping and logistics process. And then somehow it gets to your door 2 to 3 days later. And first of all, let's just acknowledge that that's nothing short of a technological wonder.
I will say, I don't know where you are, but when I order stuff, it literally oftentimes comes like within the next few hours.
Wow, that's wild.
Yeah.
So okay. We take for granted how quickly things arrive in the physical world, right? We also take for granted in the world of mostly electronic trade processing that when we say done on a trade, we instantaneously have that risk. And guess what? That's how we'll put it into our ledger. If I buy $100 million worth of bonds or $10,000 worth of NVIDIA stock, I put it in my book and I'm going to start hedging and monitoring that risk immediately. But just like with the dress you order from Revolve, that trade has to go through an entire processing system. So if the trade is done via voice or over like a Bloomberg chat, it's then inputted manually into an internal booking system, typically by the most junior person on the desk. This is literally what every single analyst and associate does in sales and trading. It's a huge part of their responsibility. It then flows downstream to middle and back office support roles. They receive those inputs, and then they're charged with the actual mechanics of coordinating wire transfers and reconciling what each counterparty, quote unquote, knows or doesn't know on the trade. So they're checking things like collateral service agreements, by the way, CSAs. They dictate the margin requirements associated with derivatives trades, like and on and on and on. There's so much that they have to do. Then there's also legions of technology guys who are tasked with constantly updating and servicing the systems that are different, by the way, from bank to bank for all those internal booking and reconciliation activities. Those systems are notoriously buggy. They have to be updated constantly because every time there's a new compliance rollout, those systems need to then be overhauled and reworked and then activated across thousands of computers all across the world. Like it is a massive logistical nightmare. And so listen, sometimes the trades that you're booking are super vanilla and they're easy to input. Some trades are totally bespoke. And there's not, like, I used to sometimes be like, I'm going to write this trade on a napkin and like hand it to someone, right? It would be like, hey, you're going to get paid 50 basis points every time the price of cat food rises above $10 a can, right? During the month of January in 2035. Okay. Like, so historically, the more complex the trade, so think like derivatives, interest rate swaps, credit derivatives, or the less liquid the product, like corporate bonds, the more opportunities there are for something to go wrong because there's more moving pieces, right? There's more parts involved with processing and settling the trades. So if we're talking about like $1 million clip of the bonds of some esoteric corporation whose debt rarely ever trades, that's been sitting in some rich old granny's retirement account in Iowa. She wants to sell them. She wants to go on, 10 Caribbean cruises. Okay. And we got an investor in Japan who wants to buy those bonds. It's all done amazingly quickly and digitally, but there's still a lot of hoops to jump through. So now scale that up to the hundreds of millions and billions of dollars in face value and derivative and notional that are trading constantly, literally every second, among tens of thousands of market participants all over the world. There's a lot of room for things to go wrong. So these grace periods were put in place, right? Historically, the settlement for really liquid, easy to source, minimally complex securities like US Treasuries, that's been T+1. And T effectively means trade date, right? Today. So, Kristen, if I ask for your offer on 100 million tens right now and you say done today, I'm expecting those bonds to show up in my account tomorrow. More complex structures like those derivatives have historically been T+2, and corporate bonds used to be T+3. But as the world has become increasingly electronic, settlement times have naturally shortened. So now everything that was previously T+2, that includes equities, corporate bonds, ETFs, credit default swaps, they now have to be settled T+1. So all of our friends who are either currently working in or plan to be working in middle office, back office, compliance, operations roles, they have likely been working tirelessly on implementation for the past year. Or if you're just about to start, you're going to need to get up to speed quickly when you hit the desk this summer, because you've got to be aware of all of the risks and challenges around implementation of this new rule. And listen, I haven't heard anything too crazy in the first 48 hours, although I made the stupid mistake of asking someone on Tuesday how T+1 implementation was going. And they were like, well, I guess we'll find out tomorrow. And I was like, oh yeah, when like a bunch of trades don't show up, right? And I think nobody was really talking about this much, but I think it's kind of akin to like a mini Y2K panic, right? And for those of you who don't know what Y2K was, when all the computer systems were first built back in the 20th century or the late 1900s, as you godforsaken young people call it, many systems were built with dates coded into them so that only the last two digits of the year, like 91 or 92 for 1991 or 1992, were there. So the fear was that when the calendar flipped to 2000, it would read in all these computer systems as the year zero, and like the apocalypse would ensue. Yeah. And obviously that didn't happen. Again, I haven't heard any big catastrophes so far. But guys, if you know or love someone who's in a support role in high finance, like, check on them this week. They're probably an exhausted ball of stress, if nothing else, and they're probably very, very tired. But I think talking about things potentially going wrong and how many moving pieces and parts and how many checks and balances there have to be in place here is a really good segue into talking about the fat finger trade that you wanted to talk about, Kristen.
Yeah. So there was an article about how Citi got fined $79 million for this fat finger trade that happened in 2022. So I want to go through this. It was honestly like it's any person's nightmare. Like hearing it, it made me, I mean, I'm sure, again, I never worked in trading, but like we all know it's like you make a mistake. Like the magnitude of this mistake was so enormous. So what happened is that 2 years ago, May 2nd, 2022, it happens to also be a UK bank holiday. It's actually important to note that this trade happened in London. But a trader basically made an inputting error. They wanted to sell $58 million worth of equities, like a bunch of different equities, a basket of equities, and accidentally sold $444 billion. Now, if you're wondering, how did that happen? It was, again, a minor mistake where they entered the units instead of the notional, right? So it's like you could sell 10 shares, but if each share is worth $40, then that's $440 worth of shares. If you accidentally put that into the share fields, then it's yeah. And so that's exactly what happened. So we entered the value in the quantity field instead of in the notional field. And normally this happens and the computer like should do the math to show you your mistake.
Right.
Problem was the Citi computer system like fucked it up. And so they, for whatever reason, instead of multiplying the number of shares times the share price, it multiplied the number of shares times -1. So the trader puts in whatever it was, like $58 million worth, and he puts it in the number of shares, and it displayed -58. So he's like, oh, cool. I did the, whatever. Like it seems to check the box. He, hits okay. Now he got 711 warning messages that popped up. Apparently,
small aside, only
small
711 warnings later.
Only 18 were visible. Now, again, 18 is still. I know.
Sure,
well, no. But in fairness, like I feel like we all get like you do something, and these days it's like there's always these checks. Are you sure you want to hit submit? Right? Like,
did you read the terms and conditions? I'm like, goddamn terms and conditions.
I think people just kind of get very accustomed to being like, I know what I did. It's all good. And so anyway, so he, I guess, like went through and hit 18 yeses or however many he needed to. And the crazy part is that the trades even went through it all. And so Citi did have what's called some like hard blocks. Basically, there were systems in place so that like it would not allow you to sell more than 2 billion of any one stock. Because remember, there was in this case, it was like 349 stocks that the trader wanted to sell. But even when those were blocked, there was still $196 billion of stocks that went through. And I guess at Citi, they had also instituted this, again, another hard block in the US, where if you tried to sell more than $4 billion of notional, right? So $4 billion worth of stock, it would be blocked. That was only in New York. It hadn't been rolled out to the UK yet. So like it continues to go through. And ultimately, so the trader went ahead, he sold like $1.4 billion of equities, causing a flash crash, like a 4% loss. And this is where I think like it ultimately was like, okay, holy shit, like, no, we need to pause. Yeah. And this is also the crazy part too. The risk managers, you're like, well, wait, what was going on? Like, where were they were on vacation. And one of the risk managers had like left 8 minutes before this.
Oh my God.
Like it was just the worst. I mean, like confluence of things that had to happen to make this ultimately go through. Yeah. But anyway, TLDR, they ended up getting fined $79 million for this.
Yeah. So the reason they had those hard stops in place is because all banks were forced to put in compliance measures to prevent that kind of thing from happening after the flash crash of 2010. So in 2010, I remember I was on the desk at Morgan Stanley. I remember the day so well. I had just showed up like a week earlier too. I was like new on the desk after garden leave. Yeah. And there was, at the time we thought it was a fat finger trade. I think the post-mortem ruling was that someone sold a $4.1 billion chunk of equities. So that's why Citi has those stops at those values, right? It's like, okay, this is what happened on the flash crash. It can't be that much. But what ended up happening was it triggered a huge wave of selling from all the algos. So all the high frequency trading shops had algorithms in place to say, well, if any one stock drops below this magnitude in this amount of time, immediately sell everything. Yeah. So global equity markets crashed something on the order of magnitude of 9 or 10% within the span of like less than half an hour. I mean, that is so unimaginable.
We need to throw a graph up on our stories today. Yeah. Let's do that just because it's like the visual of the stock market, the crash is like bonkers.
Yeah, it's insane. It's like someone had forgotten to input the data into a graph. Like they're it looks like zero, right? And I mean, hundreds of billions of dollars worth of value was erased in the span of less than an hour. Now, listen, like if it went down 1,000 points, it was up 600 by the end of the day. It recovered somewhat quickly once everybody realized what was happening. But I remember being on the trading floor and people were acting like the sky was falling. It was like, everyone's yelling like, what's going on, right? And there was a huge SEC investigation after the fact. And there have been a number of fat finger trades that have happened since. But to your point, Kristen, so many banks have put in a number of security and compliance measures to keep this thing from happening, right? Yeah. That's why you have to answer, are you sure? Are you sure?
Yeah. Well, again, I think entering the number versus the dollar notional, it's such like an easy thing to do, which is why, I mean, honestly, I blame the freaking computer system more than the trade. Like, I don't know. As someone who is like very much, I make dumb mistakes all the time. Also why I should never be a trader.
Why you should never be allowed to trade.
No. Yeah. But I still have like, it was the computer system's fault in my opinion, right? Like it should have done the math because then you can check your mistake. Like it didn't check the mistake. So you put in the number, you're like, yeah, that looks right. Okay. Like anyway, That's why
I
Citi was
blame the
fined.
trader more than you because, listen, you beat out how many? We just saw Business Insider wrote that 315,000 people applied for the goddamn Goldman Sachs internship this summer. How many people did this guy or girl beat out for that role? And you can't be bothered to do the math independently, even if the computer doesn't double check it for you.
No. But I think it's like, again, it's one of those sanity checks, right? It's like the parity check error, line in a model where it's like, okay, the number's off. This means I need to go see what the problem is. Like having those checks and balances is so important because, again, it's so easy to do the dumb thing. So the system really should, like the fact that he put the number in and then it's like, oh, look, the notional, it's the right number. Like it even in, you know what I mean? And I guess it did have in other areas, like it did have the right number, but I just, as someone who is like so prone to making those dumb mistakes, like I feel so bad for the trader. But again, I also think like know your skills and your weaknesses. If you are someone who is prone to those types of errors, do not go into trading. Find a different job. Be a salesperson. Or a banker.
No, don't be a salesperson because you'll be the one booking those trades. You can make one of those errors too. Yeah, no, don't.
So
Stay
don't
away from the markets. Stay away from the markets. Go be a banker like Kristen.
Be an ideas man. Yeah. Or an ideas gal. So that's fun stuff in the trading realm. There was another article that we wanted to talk about as well that I thought was interesting, actually in light of the conversation we had with Ron Biscardi. So if you haven't listened to that one, it was I think last week or the week before, we talked to the CEO of iConnections. iConnections is one of the largest cap intro conferences in the world. And cap intro is where the allocators, so the people that have all the money, the endowments, all that, basically meet up with the people that need the money, like the hedge funds and the private equity firms, and obviously try to fundraise. And there was an article that came out that basically like hedge funds are being hit by the lack of private equity exits. And it was talking about how basically private equity firms are currently struggling to return money to their investors because exits for these private equity firms are at like a 10-year low. So in this Bloomberg article, they talk about how the private equity backed exits fell to 345 billion as a result of the IPO market slowing down and M&A, basically being held back. And so if you have private equity firms with these portfolio companies and they can't sell the business and they can't list it, then they can't get their money out and return money and distribute that cash to their investors.
Now, one thing that we haven't yet talked about is the vehicle of PE secondaries. We have an episode recorded that we're going to release really soon. So that's a really interesting potential workaround in this environment where people may want to extract their capital. But one of the things that is happening is even though there aren't as many exits in these IPOs, generally speaking, the market is up. So people are holding on to companies that are worth more and more and more. They're not in a rush to cash out on them. So
they do need to. So it's interesting though, because the PE industry is sitting on a backlog of 28,000 companies which are worth $3 trillion. And they do, the thing is like they ultimately do need to exit because like that's sort of this whole, machine of like you exit, you fundraise, like you do a new fund, And so again,
but when you have the secondaries market, you can exit and take out some liquidity and move on with your life, right? Without actually IPOing these portfolio companies and without doing a new fundraise.
Yeah, that's definitely true, but it's still, again, it's like, as you think about where the money is coming from at the end of the day, like it's coming from the same investors who are the ones who are investing. Like it's all coming from the same place.
Like you got to exit in order to realize, I'm just playing devil's advocate a little bit here that like,
well, but again,
it's easier than ever for private equity companies not to exit formally.
Yeah, but the thing is again, like back to the sort of point of this article was that like if the hedge funds are having a hard time raising money because those pension plans, the foundations, the endowments, they aren't getting their money back from all those different illiquid private investments. It was actually interesting because the former co-CIO, so Chief Investment Officer of Millennium, which is one of those pod shops, again, famous, their fees are something like, they're not technically 3 and 30, but because it's like a pass-through model on the expenses side, like it effectively is, again, the fees are insanely high, but it's because it had like such amazing performance. So the former CIO, Bobby Jane, had wanted to go out and raise a $8 to $10 billion fund, hoping to like debut the largest ever like hedge fund.
Well, he wanted to do another Gell band and create Exodus Capital, right?
Yeah. So I guess that it's supposed to launch in July, and now they're targeting $5 to $6 billion. We talked I think a few weeks ago about how like Kim Kardashian was targeting a $1 billion fund and only has raised $100 million. So it's interesting, right?
So new private
The lack
equity
of,
is also being held up by existing
yeah,
private equity, right? So
yeah.
it's
Well,
all new fundraising, not just
if
hedge
you
funds.
True. Yeah. I mean, if you don't have a track record, like it's going to be, it's really, really hard. If you're
Yeah.
Blackstone or Apollo, I mean, that's a slightly
You're fine.
different thing,
Yeah.
right?
You're
If
still
you
probably
are
turning people
Anderson
down.
Horowitz or Sequoia, yeah, exactly. But so anyway, so it's just sort of an interesting article about the fundraising environment, something that we normally don't get into that much. And then the last thing is we're going to be talking this weekend with Ty Wallach, who is the current CIO of Atlas Merchant Capital, and he focuses on credit. And it was interesting because he used to work at Oak Hill and Paulson. And we asked him, like, what is private credit? And he's like, honestly, there's no real one definition about what private credit is. Now, if you do not already subscribe to Matt Levine's newsletter, go do it. It is amazing. But he had, I think yesterday or today, this discussion of private credit. And it was, he has just this very funny, snarky way of explaining things and was talking about the history of how fundraising works. So, like, for example, right, if a private equity firm wants to do a leverage buyout, when I was working in the business, what would happen is you would have the banks, right, whether it was JP Morgan or I was at Morgan Stanley, they would be the ones to help the private equity firm raise money. So they wouldn't just be like, here is the money, lending the money directly. They would go out and they would syndicate the bank loan, right? So they would find other banks who would want to be part of the syndicate. So like Bank of America, Citi, Wells Fargo, they would come in and together help them to raise whatever the amount of bank loans that they want were. They would then go out, they would help raise the bonds. So they would do, help with the rating agency situation. And then they would go out and they would find the Oak Trees and they would find the Paulsons. And they would, again, almost be like these intermediaries who were helping to find the money. Right. Now, JP Morgan also has $4 trillion of their own capital, but they're not the ones who are directly lending the money. You have these other private capital players. Ares is kind of the famous one who actually are doing that more direct lending. And so I guess JP Morgan came out and announced that they want to get into private credit. And this was the funny sentence that Matt Levine had. He said, in modern terms, JP Morgan just lending out money is called banks getting into private credit rather than banks being banks, which I thought was hilarious. But again, I think that the definition of private credit is it's more, you have these funds, right? So again, like an Ares, they're raising money from other institutional investors, and then they're going out and often doing direct lending. It could be some kind of securitized product situation or whatever. But it was kind of an interesting conversation that, like, when we talk about private credit, there's a whole bunch of definitions. And again, JP Morgan has an asset management arm. So they have the ability to do this, but I guess they are going out and looking to buy it.
They can retain loans on their portfolio. They don't have to securitize all of them. So if they're underwriting a deal, they can take down some portion of the deal themselves as much as they want. They just typically choose not to free up as much of their balance sheet to pursue other lending activities.
Yes. Well, I guess they also, so JP Morgan had said that they'd earmarked $10 billion of the firm's balance sheet for direct lending on private credit deals. The thing is, it's like $10 billion to me sounds really small.
It's not that much.
That sounds like nothing. So I was like shocked by how little that was. Again, they have the $4 trillion.
But their balance sheet is so much more tightly regulated than that of any of these other institutions. So they have to answer to higher powers when your Oak Hills or whomever do not. So that's why these guys can only wade into this. They have to demonstrate much, much, much more rigorous ability to withstand stresses than these other guys.
Yeah. So anyway, it was interesting. And the episode we're planning to release this week, hopefully will be Ty Wallach. If it is not Ty Wallach, it will be another amazing episode. We have really a whole bunch of great ones in the pipeline. And anything else, Jen, before we sign off?
Thanks for hanging, guys.
All right. Bye, guys.
Bye.